Does that mean that the markets are trying to accentuate the positive at this point?
I think the markets are probably right to accentuate the positive anyway. I think we are going to get a deal. I don't think it's going to be an all-encompassing deal, but it'll be a deal that removes basically an escalation of the trade war that was brewing. So as long as we get the status quo, no new tariffs, and a slow de-escalation of tariffs being pulled away, I think that's great news for the global economy. The White House administration can't fight too many battles at the same time. So with the government being shut down, with the weak Q4 on U.S. equity markets, I think it's got to choose its battles. And I think getting an easy win with a trade deal on China, even if it isn't all-encompassing, is something they'll be gravitating towards.
Patrick, where do you think the market emphasis is right now? Would it react a little bit better to incremental developments on the trade front, or would it work towards incremental developments on the end of the government shutdown? Obviously, we know the overarching theme is trade, but where would you think the markets would have more of a reaction if they saw a little bit of incremental progress at this point?
I think the trade is the one thing. I think that's a huge overhang for the whole global economy, and if we get some resolution on that and make progress on that, I think that's more important. The government shutdown is an annoyance, and it's something that probably is starting to have some incremental impact on U.S. GDP. It's not going to be sizable for U.S. GDP at this point. It's not going to impact global growth at this point, whereas a trade war, and if that escalated as the threats were there from March, that would have been much more important. So I think the market's right to look much more at China-U.S. trade relations.
There is a view out there that the December 24th lows that we saw in many parts of the market, including right here in the U.S., was an overshoot to the downside. And a V-shaped recovery, the likes that we've seen so far, is perhaps a little bit overdone as well. Take us through what your thoughts are. Is this an environment where we still can perhaps build positions, or is this a time when we take the strength that we've seen to perhaps lighten up on some of that position that we've seen gain in value over the course of the past 3 weeks?
Yeah, we're doing both, actually. So we've been building positions in emerging markets. We think that'll be the region that gets the biggest benefit out of a U.S. trade truce with China. It's a market that's incredibly cheap, trading at 11 times earnings, giving you a dividend yield of 3% right now, and growing structurally much faster than the developed world for the coming years. So we've been adding to emerging markets. U.S. equities, I think, are getting fully valued again now. So they did have the very steep correction in late December, and they've bounced right back. Market's cheap on earnings, on EBITDA, book value, revenues. The market's still very expensive in the United States. And I think operating margins and profit margins for the U.S. is one area that's going to disappoint. So I'm of the view there's going to be higher interest rates and higher wage costs in the United States. So not worried about the global economy so much, but worried about the profit margin for U.S. companies.